All right, let's dive deep into the hidden world of the Bitcoin market. We're going to go on a safari, exploring this secret ocean to meet everyone from the tiniest shrimps all the way up to the colossal whales. Why? Because we want to figure out who's really pulling the strings. I mean, it's a big question, right? Is it a handful of massive players calling all the shots, or is it the combined power of millions of us smaller folks? Well, the answers are actually hiding in plain sight, right there on the blockchain. And the key to unlocking it all is something called on-chain analysis. Okay, first things first, we got to get the lingo down, and the most important word you'll hear is hodler. Yeah, it started as a legendary typo in an old forum post, but it's evolved. It's now this core concept that lets analysts classify everyone in the Bitcoin network, not just by if they hold Bitcoin, but how they hold it. So the first way analysts slice and dice the data is by wallet size. Basically, how much Bitcoin does an entity actually own? And to make this whole thing easier to picture, they came up with these brilliant marine life analogies. It creates this whole food chain for the Bitcoin ocean. Let's start at the bottom of that food chain. First up, you've got the shrimps. These are wallets holding less than 1 Bitcoin. Think of this as your everyday retail folks, and believe it or not, they make up the huge majority of all holders. Then you move up to crabs, holding between 1 and 10 BTC, and the octopus, with 10 to 50. We're still mostly talking about individual investors here, just with a little more skin in the game. Now we're starting to swim in some deeper waters. You've got the fish with 50 to 100 Bitcoin. These could be high net worth individuals or maybe some smaller funds. Then come the dolphins, holding up to 500 BTC. Now we're talking about more serious, medium-sized institutions. And then you've got the sharks, controlling up to 1,000 Bitcoin. These are your big funds, your family offices, getting serious. And finally, we meet the true giants of the deep, the whales. Holding between 1 and 5,000 BTC, these are the major players whose every move can make massive waves in the market. But believe it or not, even they get dwarfed by the humpbacks. These are the absolute titans, the giant exchanges, the corporations, and of course, the new spot Bitcoin ETFs. We're talking more than 5,000 BTC each. Just massive. But here's the thing. Size is only half the story. It's just one dimension. To really get what's going on, you also have to look at age, as in how long has a coin been sitting in a wallet without moving. This is absolutely crucial because it helps us tell the difference between a nervous day trader and a deeply committed long-term investor. So on this super active end of the spectrum, you've got what are called hot coins. These have moved within the last week. This is the domain of active traders. Then you have young coins, held for up to 6 months. These belong to what we call short-term holders, or STHs. It's their buying and selling that often drives those short-term market peaks and valleys. After that, you get to mid-age coins, where we're starting to see some real conviction build up. Okay, now this is where it gets really interesting, because this shows us the bedrock of the entire market. Aged coins, held for over 2 years, belong to the long-term holders, or LTHs. These people have seen it all. They've held through entire bull and bear markets. And even beyond them are the ancient coins, held for over 5, sometimes even 10 years. These coins practically never move. They either represent the absolute highest conviction, or they might just be lost forever. So we have size and we have age. And on their own, they're pretty useful. But this is where the magic happens. When you combine them, you suddenly get this incredibly powerful, nuanced picture of who really has an impact on the market's supply.
And we can actually put a number on this. It's a simple little formula called the supply impact score. You just give a score for size, say 1 for small, 3 for large. You do the same thing for age, 1 for young coins, 3 for old coins. Then you just multiply them together. The higher that final score, from 1 to 9, the more that supply is effectively locked up and taken off the market.
And check this out. This chart just illustrates the whole point perfectly. A humpback whale, who is also a long-term holder, they get a max score of 9. Their coins are massively, massively illiquid. But now look at the shrimp, who's a long-term holder. Their individual score is low, sure, but the combined aggregate effect of millions of them all doing the same thing, it actually removes a huge amount of supply from the market over time. It's a really fascinating dynamic. All right, so all of this analysis, the size, the age, the impact scores, it's all building toward one single master concept that really governs the entire Bitcoin market, and that is the critical difference between liquid and illiquid supply. And you're going to want to pay close attention here because understanding this one idea is, as one analyst put it, arguably the most fundamental concept in Bitcoin on-chain analysis. It's that important.
So here's the deal. The entire supply of Bitcoin can be split into two big piles. On one side, you have the illiquid supply, what you can call the HODL stack. These are coins sitting in wallets that almost never, ever spend. For all intents and purposes, they're off the market. On the other side, you've got the highly liquid supply, or the trader stack. These are the coins sitting on exchanges, in trading wallets, basically ready to be sold at a moment's notice.
So you might be wondering, how do analysts actually draw that line? Well, they use a bunch of complex models, but at the heart of it all is a surprisingly simple rule. An entity is classified as illiquid if it has spent less than 25% of all the Bitcoin it has ever received. That's it. So simple, but so powerful. Now, tracking the flow of coins between these two stacks, between liquid and illiquid, this isn't just some academic exercise. It leads us directly to a powerful market dynamic that has real predictive power. It's called the supply squeeze. A supply shock, or a supply squeeze, it's classic economics 101, really. It's what happens when a sudden flood of new buyers comes rushing into a market, looking to buy something, only to find out there's very little of it actually for sale. And here's exactly how that plays out with Bitcoin. Step 1, long-term holders start stacking sats, moving more and more coins into that illiquid HODL stack. This literally shrinks the pool of coins that are available for anyone to buy. Step 2, a wave of new demand shows up, maybe from a new ETF, maybe a ton of retail interest. Step 3, all that new money now has to fight over a much smaller slice of the pie, that tiny liquid supply. And the result? A rapid and sometimes totally explosive increase in price. And maybe the most important takeaway from this whole thing is this. This isn't just some short-term event. The data shows a crystal clear long-term trend. Year after year, a bigger and bigger percentage of Bitcoin's total supply moves from that liquid trader stack over to the illiquid HODL stock. This is a sign of the network maturing, of more people seeing it as a long-term store of value. Which leaves us with a pretty fascinating final question to chew on. If more and more coins are being locked away from the long term every single day, and we know new waves of demand are always on the horizon, is the next big supply squeeze really a question of if, or is it just a matter of when?